Hello everyone and welcome to another ASEG Partner webcast. My name is Susan Revoletto, Membership Support Specialist here at ASEG. I will be your moderator today for this event. I'd like to thank everyone for taking the time to join us today for this presentation. Today's webcast is being recorded. The link to the recording and the accompanying slides will be posted to the ASEG website, and all registrants will receive an email with the link to those materials. Today's webcast is titled Revenue Recognition, with the deadline looming. Are you ready? And it is brought to you by ERPfixers, an ASEG partner. I'd like to remind our audience members that you can submit your questions at any time by clicking the purple Q&A button at the bottom of your screen. Also, please take a moment to expand your live view box. Just go ahead and maximize it so you're able to see all of the little details throughout the presentation. And now I'd like to hand it off to Paul.
Thanks, Susan, and thank you everybody for attending this webcast. I'm going to take you through the first 3 slides, and then I'll hand it over to Kent. So my name is Paul Ovigel. I'm the founder of ERPfixers, and ERPfixers is an online platform for posting SAP requests, questions, and issues. We have about almost 4,000 experts who are available in most of the SAP modules. So I'm pretty sure that if you have an issue or request or something you want to have more information about in the SAP system, I'm sure there's someone that can assist you. We also offer optimization assessments in most of the major SAP modules. So if you have an area of SAP that you think is not being fully utilized, we can actually select one or many people that can help you out with that. We do it in most of the modules, and more recently we are doing it with S4HANA as well. If you need more information, you can go to our website, ERPfixers.com. Now I work predominantly in the FI and CO area of SAP, and recently there are 2 major areas I get questions about from people wanting to know what to do in the future with, and one is S4HANA, the second is revenue recognition. So I think this is a pretty good topic and hopefully a timely topic as well. And I couldn't think of a better person to deliver this than Kent Bettisworth. Kent is a CEO and executive consultant of Bettisworth Associates. He worked for ExxonMobil and then started his own company in 1995. His expertise is in SAP and wind shuttle technologies, and he's done things like implementing the new revenue recognition and lease accounting standards, project management, fixed assets, and federal tax solutions. He's worked for multiple Fortune 1000 corporations, and they've used his services and advice for the past 2 decades. And he's a frequent speaker at SAP conferences and ASA conferences as well. So Kent is not only a speaker and trainer, but he manages a few implementations with revenue recognition. So I'm pretty sure that you will get a lot of value from this webcast. So now I'm going to hand it over to Kent, and I will be back during the Q&A if there's anything that I could answer. Thank you.
Thank you, Paul, for that nice introduction. I'll try to live up to those high standards that you elaborated on. So yes, revenue recognition. If you live in the world of finance and you live on the income statement, then you have probably heard about the new standard that's coming for revenue recognition. And in fact, the date to adopt it for all publicly traded corporations is the 1st of January. If your fiscal year ends in December. And if your fiscal year is after that, you have a quarter of extra time all the way up through September of next year. If you're privately traded, it's the adoption is a year after that. So what I want to do today is share with you the impacts of this, and I may come at this from a little bit different perspective than what you're used to. I'm going to talk about reporting, and specifically with the adoption date in January, that means the first quarter reports coming out in April for folks with the fiscal year at the end of the year, calendar year, will be talking about revenue recognition. And specifically, they're going to talk about how the new standard, ASC 606, that's the FASB numbering standard, accounting standards code, has changed. And specifically, if you look at this slide, the changes are around external disclosures. So it's not as much as the actual numbers that have changed on the income statement or the balance sheet in specific, but it's how you explain those. What's the nature of your revenue? What's the timing? What's the amount? And what's the uncertainty? Now, it seems like simple things. You say, yes, I've been doing that so far, but I'll have a few slides a little bit later that will elaborate on why this is very different. This is very different from what you're doing today. So the first thing that's different is that the Accounting Standards Boards provided an option on how you did your transition to the new standard. The first option was to do a full retrospective, which means you should have already been reporting and showing what the differences would have been to 606 for the past 2 years. It's too late for that. Right? That's what I call OBE, overcome by events. Your only option now really is the modified retrospective, which means on your adoption date, you will adopt 606, and then for the next year, you will report on how your revenue, nature, amount, timing, uncertainty has changed. So, for example, if today you have a software license that you recognize over time, so the revenue stream is spread out over 12 months, 24 months, but under 606, you now recognize all that up front, you have a variance. So in that first quarter, 605 would have been $100 on a $1,200 subscription, and now you're going to report $1,200. So you have an acceleration of $1,100 in revenue. But that's not all you have to report. Okay, so let's keep talking about this. So to get an idea of the audience and where you're at, we have 2 polls. The first poll says, when is your adoption date? And it is, and I want to know, are you adopting here in January or some other later time? So if you would just make your choice between those 2 and then hit submit, we'll take a look at the results. So I'll give everybody about 15, 20 seconds to submit your response, and then we'll go to the next slide to see the results. When is your 606 U.S. adoption date? And if you're international, you can also reply. The dates for the international adoption is similar to the U.S. So you can tell me it's here in January or it's later. All right, let's take a look at the results. And so we have roughly 40% of you are coming up on your adoption, and the rest of you are later than that. All right, cool, thank you. Now here's the second part. Is your contract roll forward external disclosure report ready? Yes, no, or I don't know. The contract roll forward report provides an analysis of a beginning balance to an ending balance over a quarter. And inside of that, you're explaining, similar to what you might think of today if you do income statement analysis on revenue, a price volume variance. Was it the price that drove the change? Was it the volume that drove the change? So have you prepared that roll forward report? Give you a couple more seconds to answer. Yes, no, I don't know. All right, let's see where we're at. So, yes. Now, this does not surprise me. A few of you have actually got that report, looked at it, you've got it ready, and then it's equally split between no or I don't know. The rest of this presentation is going to be about, in particular, this report and how important it is to your project and a successful implementation. So let's see why that is. Yes, this slide, if you recognize that famous character of the Mad Hatter looking at his clock and saying, I'm late for a very important date. And in this case, you're probably late on your reports. You're probably not ready. Maybe some of you that answered 7% of you are. So let's talk about what these disclosures are really about. So this slide is intended to organize the 606 topic in a way that you can understand and break down the amount of information that you're now required to report on. If you look at the section that's labeled in red or colored in red, the nature, the amount, the timing, and the uncertainty of your revenue and cash flow streams, or you have contracts. So another way to look at this information is these 5 boxes that are organized on the right-hand side. If you look at the top, this disaggregation of revenue, some of you may think of that as your segment reporting today, where you break it down by business line or country or region. It's much more than that. But that's one of the first significant reports that you will use to then explain in your disclosure notes how your revenue is distributed, disaggregated. Moving to the right, you have contract balances. This is the next large area of reporting requirements where you need to examine your contracts. Yes, you need to examine your balances, and specifically, you think about the balance sheet, you may have some revenue that's unbilled, but you've recognized it, or you have revenue that you have billed on an invoice, but you haven't recognized the revenue for income statement purposes. So those 2 balances under 606, those are now called contract asset and contract liabilities. You have to break those down at the contract level. And in fact, you have an option to break it down at the performance obligation. Performance obligation tomorrow is the same as basically a sales order line item today on your sales order. At the high level, there's a whole lot of detail below that may actually have you combining line items. But in your contracts, you're explaining the nature of that revenue stream, how it's changed, what the amounts are. There's some uncertainty about that revenue stream that you may have to explain also. Next box down to the right again is performance obligations. So that's the same as explaining at the line item level on your sale to a customer. What is that? Significant judgment. So throughout 606, there's a clear move towards providing management the opportunity to make some judgments about the revenue, more so than what might have been there in the past where we had under the current 605 some very rigorous rules that we use, some bright lines as we call them, that boxed in your judgments. That's a little more open. Now with that comes more explanation, which means your disclosure notes and your disclosure reporting must be more elaborative. Then the other box is about there's a section in the new 606 about what cost you need to capitalize rather than recognizing it as revenue. All right, so we're just beginning here. Now, if you look at your company's annual reports or quarterly reports and you look at the notes section to see what do they say about revenue, you'll typically find something similar to what I've got here for these 3 companies. And I've highlighted in red, for example, the top left, and you can probably guess who this is. They recognize revenue as each airplane is delivered, the unit's completed. Next one down is it's primarily recognized on a percentage of completion, right? So that could be some A&D, engineering, construction type of companies. And then you have another company who actually has the percentage of completion, but they also use the completed contract method where nothing's recognized until it's substantially complete and delivered. That's not what 606 is about. Yes, this statement may actually change a little bit, but it's just the beginning. The question I have is, have you had discussions with your executives and audit committees about these disclosures beyond just these examples that are here? If you haven't and you're implementing soon, you're behind the 8 ball. All right? Now, to give you further detail in terms of what I mean about the expanded disclosures, here is a partial list of paragraphs from the 606 accounting standard specifically describing the various reports. So if you just look down this middle column and look at the list, you'll see there's a revenue disclosure report, an impairment loss report, disclosures by customer, disclosures by customer segment, open and closing balances, as I mentioned, about your assets and liabilities, which liabilities have been recognized, how has it changed, how are you aggregating it at the performance obligation level. So the whole, as most of you may know or may not realize, the whole reason for this new standard, which has taken over 10 years to get agreement around the world, and this standard applies to all companies. Investors wanted more clarity. That was the big message. there was too much differentiation from one industry to one company and the next. You couldn't fairly make a good comparison as to what the nature, amount, timing, and uncertainty was about that revenue stream. So if you're going to invest in a company, you want to have a clear idea of where they're making their money and where the revenue is coming from. That's the genesis for this consolidated, comparable, single standard. There's no industry standards. Previously, we had lots of industry standards. 606 spells out, and you won't find any industry specifics in there. Okay, it's to make everybody work from the same requirement. Now, what that's done, of course, is there's been multiple task force to try to help companies transition from industry-specific reporting to this single standard. And in the process of that, one of the things that you definitely have to look at, if you're not aware of this already, is that all of your there's a big impact on reporting, both for external, which is going to be new, and for internal. I'll talk about internal in a minute. If you look, here's just an example of how your inventory of external disclosure requirements might look. So if you look in the second column, we have some capitalized costs, contract analytics, assets and liabilities, and so forth. So in this case, there were 14 gaps from what you might have been reporting before. Did an assessment of complexity, because obviously you're trying to understand how much work might be required. So no new or no existing reports. They're all new reports. And so, yes, I'll talk about that in a minute. There's some SAP delivered. There's other companies that have provided some standard reports, or you may be doing it yourself. So this impacts your project plan and your work. It's not a small amount of work around these external disclosure reports. So what is out there to help me with this reporting? So the first thing you do is you break it into your operational or internal, how you manage the business, whether that's forecast reports, build reports, or unrecognized revenue reports that you have today. The right-hand side gives you a roadmap to how to group your external reports. Similar to the previous slide where you categorize them, this gives you a little bit different view. And if you follow the path all the way to the right under notes and disclosure, you'll find that underneath those notes and disclosures, you have reports that are quantitative. So those are numbers driven, right? Those should be fairly easy for you to get to the detail. If you've set up your system, if you're using SAP's revenue and reporting solution, you know that there's some data attributes that you'll want to tag onto those performance obligations and onto your financial postings back to ECC so you can get to the quantitative detail, but there's also qualitative. So the qualitative is always an area where you have to spend quite a bit of time to understand what quantitative information is going to help you get to a qualitative. And so that's where the management judgment is going to come into play. So in your process of preparing your executive for the investor analyst session every quarter, that's where it culminates. And how well you've prepared your processes and your systems to provide and feed the data that the executive needs in explaining how their revenue is being managed and being changed on the new standard will determine whether you're successful or not. Now, every CEO and CFO, I am certain, will tell you, I know my business, I know what's happening, I can explain it to my investors. And I do not disagree with that. The key point here is if the actual numbers reported to the SEC do not support those statements to the investors, big red flag, there will be issues. So the purpose of my discussion today is to tell you, you want to support your CFO and CEO and give them the correct data so that they can properly explain this level of detail to their investors and not be have a big disconnect between what they're saying and what the numbers actually say, per the accounting standards. Moving from the external disclosure side of it, if you look at your internal management reporting, here's a way to organize and maybe look at a little bit lower level of detail. So if you looked at the GL level, yes, we're making financial journals into the ECC. So for this transition reporting, you actually, for 1 year, you need to report both the new way and the old way. Well, one way to do that is with GL accounts and a parallel account basis. So that would impact every report you've got. So you have to go look at all your GL reports that are affected and make adjustments. Rolling down into the profitability side of the house, if you have a 605 revenue and a 606 revenue that are running in parallel, you have to be able to separate those. Same thing if you're using internal orders or WBS element reports, those are affected because you may have parallel cost elements. At this point, I'm always fond of saying to folks, so if in your first quarter report you're all excited because revenue's doubled, you probably have a problem. You've probably added 2 GL accounts, one for 605 and one for 606. So if you see doubled revenue in the first quarter after you adopt, don't put that number out yet until you dig into it further, okay? Let's look at this a little bit further. So if you are, one of your key decisions that you make in adopting the 606 is how to report the 606 and the 605. One way to do it is through a parallel general ledger accounts. And this picture is meant to show that. So in the center you have your receivables, cash, and revenue. So if you send an invoice today, you typically would hit revenue. With the RAR solution, we actually take that invoice amount that's posted to revenue and we throw it into a adjustment account. Then, using RAR, we post a journal entry to a 605 revenue account and a 606 revenue account. Now, one of those is your current period reporting. So if you have put in a system before you've adopted 606, you're reporting your 605 to the SEC, but you have your 606 GLs and balances to report on. But all of your reports need to be able to separate the two. Now, you can also use get the dual reporting through parallel ledgers, through the new GL and the like. But the idea is you have to be able to separate your 605 and your 606 revenue. And what you're really looking for, of course, is like that software example, where instead of over time, you're now recognizing it up front. And it's much more complicated than that, but that's a simple example. So when you run any internal report, and in this example, you have adopted a parallel GL approach, you got to make sure that you don't have the wrong combination of GL accounts, that you know what your 605 accounts are, your 606. So at the very bottom part of the page, for example, one way to manage this dual reporting is, in this case for fiscal 18, you're on 605 still. You haven't adopted 606. So you have your common account, 523-100, and you've created 2 new accounts, a 523-106, and then notice the Z523. Well, what some folks are taking advantage of is their statistical reporting is based on that 606. So they'll take they'll have a substitution rule that when it comes out of RAR, it says, oh, throw a letter, use my letter account so that I know that that's a transition. And then when I adopt 606, my Z523-108 becomes 523-108, and I post to it, and my statistical parallel reporting for 605 now has the letter in front of it. So that helps with a parallel account, parallel GLs. All right, let's take a look at another one. Same thing at the profitability level. You need to look at your key figures. I apologize, this slide may be a little fuzzy, but the idea is the red boxed area is I've got a 605 revenue and a 606 revenue. You don't add those together. They're reported differently. And that's where you would dramatically see the difference between a timing change in your revenue. So all of your reports need to be able to provide that difference. All right. So what about external disclosures? Let's look at the disaggregation of revenue and the contract balances. With SAP, you get some delivered reports, and those reports will provide you a certain level of detail, but it is highly likely that they will not provide you the level of detail that you need. There are some companies that are active in this revenue arena who have already pre-developed reports that probably get you to 90% of what you need, and then you could tweak it. So I would encourage you to talk to companies like Bramisol and others to see what pre-delivered reports they have if you need to leverage those to accelerate meeting your reporting requirements. This example that you're looking here, and I'll point out just a few things, was custom built for a particular client, but what they need is similar to anybody else. So this highlighted is a short code for the revenue category. In this case, you've got a group of contracts and POBs that reflect deferred revenue where it's in excess of the delivery, deferred revenue in excess of a POC fulfillment. So there you have two different types of revenue recognition methods. And then here's another one that's revenue deferred where you have a over time fulfillment. Couple things here. There's an accounting principle label that we use so you know which principle you're reporting on. Of course, the GL accounts. And then over to the right-hand side, you see some numbers associated with the revenue contracts and the performance obligation types. The key in any of these reports is having your SEP RAR system or whatever system you're using tagged at the lowest level so you can then get a good roll-up similar to this report. This report starts with a balance. I'll read it to you. The beginning balance was $86,000 at the first of the period, and at the end of the period it was $147,000. So being able to have this detail, you can now explain the nature and the timing and the uncertainty associated with these different fulfillments. Disaggregation of revenue is another one of the big areas. This one was custom built. And again, in this case, instead of focusing on the POB types necessarily, we wanted to be able to provide it at the business unit level or the profit center level. You still have the POB types. If you look to the far right, you see POC technical, time based on statistical key figures, completed contracts, and the like. And in this case, this is the 605 reporting view, which should be similar to what you're doing today. This last report, one of the other requirements that you will want to know is when you make a change to a sales order or contract, the contract modification, what kind of modification was it? Was it a price change? Was it a new POB that you had new sales order line item? Did the transactional amount change? Is that transaction then needing to be incorporated where you've allocated? So those of you that are familiar with the requirements of the new standard, you know that in some cases you need to reallocate the total transaction price. So for example, you may have in the past included a warranty or some item that's free. Typical example is buy a cell phone subscription, you get the phone for free, at least you used to. Well, the free stuff from revenue reporting and the standard reporting need to actually be allocated part of the transaction price. So when you go to analyzing all those kinds of changes, you're going to need a report. This is just one example, and in this case, this is not the final version. You need help making an analysis of those kinds of changes. Was it a change in the transaction price? Was it a change in the quantity? Was it a new order? Did you end up combining two contracts because they were actually related and it should not be distinctly separated? Now, I know I'm talking fairly fast through these reports. The purpose for going into a little bit of explanation is to give you the sense that there's a lot more here, and I'm only touching the surface of this. There's a lot more here under this 606 reporting standard and under the international standard 15. It's similar to this too. Now, I've got a couple of slides where I snipped some information from an analyst with the Office of the Chief Accountant with the Securities and Exchange Commission. Those are the guys that are tasked with ensuring that the market is fair and efficient. And when folks look at these 10K and 10Q filings and the annual reports, they're looking at accurate information. So this analyst spoke at a Bloomberg conference in New York in May. Now, I've taken a few things that I think are relevant and highlight the importance the SEC is putting on this, and they're crystal clear. First bullet says companies are required to talk about their transition to the new standard. So it's to disclose, and the disclosure is not supposed to say it's in progress, everything's going good. It's supposed to be more specific. So a number of companies have, in fact, done that, and the SEC is encouraged. However, what they've also noticed is that many companies are saying, well, the impact of this new revenue standard is not going to be material. The SEC doesn't challenge that part. What they are challenging is that the changes in the new revenue standard do affect everybody, and even if the change on the balance sheet or income statement is not material, the new reporting requirements could be material. So if your company was one of those ones who said, we've looked at it, we've talked to our auditors, our external auditors, our internal auditors, everyone agrees there's no material change in the nature, the amount, or the timing. If that's where they've stopped, someone should ask them, have you looked at the reporting? Have you looked at that long list of paragraphs in 606 to see exactly how you need to break apart your disaggregation of revenue? The explanation of your balance change from one quarter to the next, those are new. That level of detail they're asking for is new, and it could very well be material. So that's the number one caution. And the SEC is crystal clear. Go on to the next example of what could impact you. So why should you talk to your legal department? Right? Well, take a look at this 5-step model. So this is the execution part of the new revenue standard. This is not what the new revenue standard is about. This is how you execute it to get to the detail that you need. You identify your contract. Do you have two separate contracts, or do you have contracts that actually are related and cannot be distinctly separated? What are the performance obligations? Are you giving away something for free? Right? And so you need to allocate the transaction price. Do you really know what the transaction price is? Is there some variability to it? Is there some uncertainty to it? There's some dependencies for things happening. Many of these things happen today, but under the new standard, you're required to report them differently than what you do today. And then you have to allocate the price. So many of you who have been in the software industry know that you have this standalone selling price that you've used. It was previously called BSOE under the old standard. Now it's called SSP, and it's applicable to everybody. The standard does not differentiate. So if you give stuff away for free, you need to apply the formulas to properly allocate it. And then you recognize revenue. So you need the legal department to look at your contracts to make sure that you're following the letter of the accounting standard in terms of what contracts should be combined, which ones should you be allocating revenue to, and the like. And here's just a couple of excerpts from the speech that Sylvia gave in May. So the new revenue standard provides a definition of a contract, and it specifically, your contract has what's enforceable, rights and obligations. That's a key element of what do you have a revenue contract, and how do you need to then account for it in the new standard. Specifically, all the contractual terms. So typically, that's where your legal guys need to get involved. And some specific examples are termination clauses, repurchase rights, options. These may all have a significant effect on what's enforceable or not. And that goes then to some management judgment on how you account for that revenue stream. So I know I've got a lot of you down into the details and the trenches and the nuts and bolts, and your eyes are glazing over, and that's part of my point, is that there's a lot of detail here, and it takes time to understand and analyze it. Performance obligations, this concept of a deliverable is not, under today's revenue, is not the same as a performance obligation. There are differences. So even though you may look at your contracts and the terms and conclude that it's basically the same as today, there's no change, in what the Office of the Chief Accountant has seen, most registrants are concluding that their performance obligations are consistent with what they do today, but you still need to look with a fresh set of eyes at the external reporting. All right. So what do you need to tell the SEC? And you are required to be telling the SEC every quarter where you're at in your transition to the new standard. In fact, they have a very specific bulletin, 74, topic 11, M, that specifically said companies should provide transition disclosures of the impact of recently issued accounting standard. By the way, this is not unique to just the revenue standard. It's any of the standards. What will its impact be on your financial statements when you adopt it in the future? And specifically, you should disclose the status of your implementation process and any significant implementation matters. For example, if you followed this and you've looked at some of the industry task forces that have been assembled, have been looking at the industry transition, you know that there were and are a lot of open questions about how to move from the industry standards to this new single standard. That would be something that you would typically want to disclose. And you wouldn't be alone. Everyone in your industry is grappling with some of the same issues. So it would be appropriate to address some of that. And yes, is it easy to just throw a comment into a note that goes in your quarterly report? No. Obviously, there's a lot of consideration given to what you say and what your exposure is and the like, but the SEC is specifically calling out that you should be commenting on this so that your investors are informed, or said another way, not surprised. Okay, so I've gone through this in a fairly rapid fashion. Hopefully you've gotten the point that you should be looking at your external reporting requirements first. I call it working backwards first. Go to the end so that when you are in your project, you know what your detailed data requirements are and you ensure that you're providing that, rather than just doing the 5-step model and getting that all right, and then you realize that all your reports are not going to support it. So what I'd like to do now is thank you for attending, and thank you for being part of the ERPfixers idea and concept. It's an excellent one, and I support it very strongly. Let's open it up for questions now. So I'll turn it back to Paul and Susan.
Thank you, Kent. We are now starting the question and answer portion of our webcast. Please take a moment to submit any questions using the purple Q&A button at the bottom of the screen. All right, we do have a couple of questions here. The first one is, this does not affect my company. What am I missing?
I'll come back to these last couple of slides. If your company has concluded that it does not impact them, my question back to the team that concluded that would be, have you looked at all of the external disclosure reporting requirements, and do you still have the same conclusion? Has it been reviewed with your internal audit committee and your external auditors? If the answer is yes, they've reviewed all 150-plus requirements in the external disclosures, and the audit committee has reviewed this, and your external auditor has reviewed it, then I would say you probably should feel pretty good. However, my caution would be is I think that there are a number of companies, if you read all the literature that's been published in a lot of the columns about this reporting, April of 2018, stay tuned. You will find out then if you are on the correct evaluation side of this or not.
Okay, thank you, Kent. The next question is, would we have access to the slides after this presentation? And I think I'll take that. Yes, a copy of the recording and the slides will be sent after the presentation. The next question is, this presentation focused on the use of RAR, but that has only been generally available since March 2015. How many customers are actually using RAR? What about the rest, assumed to be the majority, who are using old functionality like basic SD revenue rec?
So the first question is probably better addressed to someone from SAP. Informally, what I understand is that there are a number of companies that have gone live, including SAP itself, on the revenue and reporting tool. There are, I don't know, the numbers vary, 50 to 100 or more companies that are in the process, all of which have different adoption dates. And there are increasing numbers of companies that are looking at the tool to start to adopt it. Now, quite frankly, some of those companies are late to the party. They have a 1/1 date, and they're trying to implement or looking at implementing. And the short answer from a consulting perspective would be, I can't implement RAR in 3 months and do it right. It'll probably be an implementation failure. So what is everybody else doing? Well, what everyone else is doing is essentially saying that we can handle it with our existing systems. Now, if you think SD RevRec is going to do it, I will tell you just very plainly, it will not. It will not handle the dual reporting requirements specifically. So what does that mean? That means that you're basically going to be extracting a lot of information, throwing it into some other tool like an Access, Excel, or whatever your favorite offline non-ERP system is, and having a lot of manual effort to do the manual correction or manual interpretation from a old standard to a new standard, like that software license. So think about it. Yep, you could throw that into an Excel spreadsheet. One column's your 605. It's $100 a month for 24 months. Next column is 606. It's $1,200 up front. But if you are a company with a high volume, you're probably going to struggle with that. The cost of all the manual effort to do it is going to maybe get you what you have to spend because you're late to the party, but then you're looking at a project implementation to, as with all ERP software solutions, you're doing it because it's more efficient than having armies of people sitting there doing it. You're going to have some pain in the short run, but you want to look at it in the long run. There are some companies who think this doesn't affect me. I can keep using my SD RevRec to do this. And I'll allow that I could be incorrect, but I think based on everything I've heard and all the discussions I've had, if you go to HANA, the current SD revenue recognition process goes away. So you will eventually be needing to look at this anyway. Whether you're, after a year, you're on one standard anyway, you'll need a solution that handles the new standard under the 5-step model. I think I answered all the questions there.
Thank you, Kent. The next question is, in your opinion, how long should the project be for a Fortune 500 company to implement RAR the right way?
So you'll hear various numbers from, roughly around 18 months to do it right. So obviously if you're January 1, you don't have 18 months. But I'll tell you the more accurate answer is to understand your revenue stream. And so let me give you a big contrast. If you simply ship and bill, and when you ship it and bill it, that's your revenue recognition trigger, and that's 100% of your revenue, you probably have a little bit easier implementation. Unless your contracts have a whole lot of criteria, contractual clauses that actually make that actual revenue number uncertain. Then you need the ability to handle that under the new standard. So then that adds some months to analyzing that particular kind of contract. Now, on the other hand, if you have 6 different ways to deliver software, and some of them are subscriptions, some of them are licenses, some of them are bundles, you have a much more complex scenario. And the more complexity, obviously, the longer it's going to take. So it typically is a 12 to 18 month exercise based on your revenue recognition requirements. And that's where you have to start first. What are your revenue recognition requirements and how are they changing?
Thank you, Kent. Next question. What is software requirement to have implemented RAR in SAP ECC 6, EHP6?
I think that question is going to the technical requirement side of it. So I'll answer from the technical side. So that's the system that you described that you're on is fine. It's actually a little bit lower requirement for it in terms of the system basis. And there are several combinations of this. We've been, in this case, if you're just ECC sales orders, RAR is a solution that basically sits on top of, it's just another component of ECC. And the current release is release 1.3. There's been a couple of support packs to bring it up to the latest requirements. You may also have a e-commerce or hybrid system that can be integrated in. You may have a CRM system that is a component of your revenue recognition process and stream. It handles those. It also has the ability, if you're not on SAP, where you could put in a ECC Lite to get your organizational structure, maybe profit centers and GL accounts, and then with RAR on the side of that, and then feed the revenue and reporting recognition solution from some non-SAP system. That functionality is also there too. So it doesn't have to be just the SAP ECC environment. It can be other environments that you're feeding. The big difference there is that if it's SAP ECC, you've got some built-in interfaces from your sales orders and CRM and hybrids. And if it's a non-SAP system, you'll have to build those interfaces. And that comment is to anybody who doesn't have a 1.1.18 or is going to do it later, obviously. Good questions. Very good questions.
Thank you, Kent. The next question is, do companies seem to be also changing all of their internal and management reporting and metrics, or do most companies appear to only be changing their external SEC reporting to align with the new standard?
I'll be honest, I don't have good insight to from a broad scale of what companies are doing. I have exposure to a couple of major companies in terms of what they're doing. And, for example, one of the things they're looking at is where they have a very decentralized revenue team managed at a very high level. They're looking at whether a centralized revenue team would make sense. So I think this standard has caused a number of companies to look internally at, are they managing the revenue process as efficiently as they can. I don't have enough information to make a broad statement about generally which direction that's going. Probably the larger accounting firms, and I would look at their literature to see if they're getting any insights that they're publishing about that. It would make sense that you would want to look at it. Again, it goes back to what are your basic revenue streams in your company? If anything, you may be beefing up your your financial analysis and reporting group because of the significant increase in the external disclosures. And then with every one of those, you need somebody who's done the analysis and can explain it clearly for that one line that goes into the external disclosure report. So if you're adding 50 lines of new information, there's somebody behind that line providing the detail. So that could very well be a natural outcome of looking at this.
Thank you. The next question is, won't the FASB SEC postpone the implementation date?
That's a great question, and I've talked to a number of companies, and these are companies who have called me recently and said, oh, man, our CFO just told us we need to put in place a new system, and in fact, the person said somewhat jokingly, well, this is going to get postponed again. The answer is no, and that's my opinion, all right? But based on the history of this particular standard, I'll give you some reasons why I believe that this will absolutely not be postponed. Number one, it took them 10 years to get converged on this standard. Secondly, revenue is like the number one top area where fraudulent and negligent activity occurs. It's the number one thing that can get a CEO and CFO in immediate hot water, if not with their auditor, external auditor, but with the SEC, because the SEC is protecting the investors, right? So they've already postponed this once, right? And if you read all the pronouncements coming from the chief accountant office, you're not hearing anything or from the FASB that is suggesting in any way, form, shape, or fashion that this is going to be postponed again. And given that we're 3 months from the adoption date for a large number of companies, highly unlikely. Possible? Yes. Probable? No. Now, that's my opinion based on what I read and what I see and what I hear as we talk about this implementation. So if that's your solution, you probably ought to have a plan B.
Thank you, Kent. The next question is, how does or how can RAR handle revenue recognition based on estimates when customers' actuals are submitted a quarter later? Or are there other tools?
So when you talk about the estimate, this probably goes to some of the industry standards that I may not be as fully exposed to that I would like to. Haven't had to deal with the estimate side of the house. I know it's a topic that's been addressed in a number of the industries, but basically what you're suggesting is that you don't really know what your transaction price is because it's based on variable volumes. And so then you need to be able to have that volume each month to then record the actual revenue that you recognize. So there is functionality for handling that. That's probably the extent of what I can do to answer that particular question.
Thank you. The next question is, for a mining company with sales restricted to a few customers, do you think RAR is a scope? So
let me try to translate that. So you have a couple of customers. That's the 99.9% of your revenue stream. It seems like it's straightforward in terms of your what you see coming in. My question back would be, what's the contractual basis for recognizing revenue for those folks? Do you have any of these uncertainties under the new standard that would require you to report that revenue stream different? At the end of the day, there's several things we're talking about. Let's go back to those 4 terms on the external disclosures. The nature, I make money off of 2 customers. The timing is based on delivery or whatever the contractual definition is of when you have performed your service or delivered the product that you have promised to the customer. And then are there terms like if you don't deliver by a certain time, there's liquidated damages. What's the probability that will happen? Does it happen often enough that you now need to account for that in your revenue stream? So those are just a couple of examples of questions that you really have to dig into with your technical accounting team and your legal team on these contracts to know whether you have to disclose some additional information in your external report. And then the question becomes, can I get to that detail in my current system? So I've used the term, you need to work backwards first. You need to go to the external disclosure requirements, understand them intimately, look at how they compare to your existing contracts, and see that you're accounting for each aspect of that nature, timing, amount, and uncertainty with management judgment applied on top of that. And the standard has throughout it examples of where you can apply judgment as to whether it's material or not or how much you need to disclose and the like, and then determine whether you need a system, a different ERP system to capture the detail. The whole idea is an ERP system is there to make you more efficient, meaning you don't need an army of people to do this. You need a system that does it effectively, accurately. That's how you know whether you need RAR. Even if you only have 2 customers, you could come to that conclusion.
Thank you, Kent. The next question is, RAR requires a separate license, correct?
No. Actually, if you're comparing solutions, and there's a number of other solutions out there for handling revenue recognition, SAP's is part of your existing contract. It is not a separate license. There's no additional cost, no additional maintenance. no addition. You may have new licenses, but it's not a depends on how you're organized in terms of your existing business. But it does not. It's part of your existing product suite maintenance and pricing.
Thank you for clarifying, Kent. The next question is, what all criteria is needed to be met for the company to be required for this reporting?
Well, I think, so that's kind of what we've been talking about, right? You really need to look at 606, the accounting standard, and look at all of the reporting requirements that have changed in terms of what you need to disclose to your investors, and compare that to what you're doing today and what your ERP system provides you today, and then that allows you to reach the correct conclusion. So there's a question underneath that, which many of you may be thinking about if you haven't already done this. So there's an assessment. So how long does an assessment take? Depends on how much information you want to be able to determine what the project plan would look like. An assessment could be anywhere from a quick 2 days to a 4-week exercise. And out of the 4-week exercise, you end up with a detailed project plan that you can then go execute. So whether you're thinking about RAR or any system, or you're not trying to do it by 1/1, because quite frankly that would be an implementation failure, unless you're one of those really simple scenarios, in which case you may not need it. You do want to do an assessment. And then what you typically want to do when you actually execute the project plan beyond the assessment is you're doing a lot of detailed testing around groups of scenarios. So, for example, one of the things you might do in the assessment is do an extract of all your sales order line items and do a detailed analysis of and group them. Because what we've discovered is you sit down with a group of folks and they tell you what the revenue recognition methods are. And so you get 5 of them. And then you go look at the detail in the sales system and the revenue system, and what you find is there's not 5 of them, there's actually 15 of them. There's 5, but there's 3 variations on every one of those. So, and all 15 of those revenue scenarios and variations have to be addressed. Simply put, you take your sales order line items or your CRM items or your Hybris items and you feed them to the solution to do your parallel reporting. Well, if that mapping of the detail doesn't allow it to determine a revenue recognition method, such as overtime or a point in time, then it's going to sit there saying, hey, I don't know what to do. So there's a massive mapping exercise that can be there. So I'll stop there just to add to that comment about how do you know whether you need to implement a system like this or not.
All right, thank you, Ken. Looks like that's all the questions we have today. I just want to give Paul and Kent a big thank you for hosting this webcast. Do you guys want to leave any closing remarks?
I would just like to thank everybody that attended the session, so thank you.
Same here. Thanks to Kent. Thanks to everyone who attended. I definitely learned a lot from this. I hope you did too. You can see that Kent is a repository of information on this topic. So please feel free to reach out to Kent. Reach out to us at ERPfixers if you have any other questions, and we will be happy to help you out. Thank you very much.
Thank you.
All right. On behalf of ASUG, I'd like to thank ERPfixers as well as all of you who took the time out of today to attend this webcast. The recording and the slides from today's program will be posted to the ASUG website, and all registrants will receive an email with the link to those materials. With that, I would like to close today's webcast. Have a great rest of your day, everyone.